Bull Bear Buzz Podcast for decoding markets, fueling minds.
You know how the market loves to keep us on our toes. After a solid 7-day winning streak, the Indian stock market decided to take a bit of a breather on Thursday, April 24th.
It's the kind of move that makes you stop and ask, okay, what changed?
Exactly. And that's precisely what we're diving into today. We've pulled together a whole range of financial news and analysis.
That's right. To try and understand the factors that brought that rally to a halt, our goal really is to cut through the noise and give you the key insights.
Yeah, we've looked at the broad market movements, of course, but also earnings reports. Think HUL, ACC, Nestle, Maruti Suzuki, Dalmia Bharat, Supreme Industries too.
And we've zoomed out, looked at global influences, things like Japan's bond market moves, the ongoing, saga of U.S. tariffs.
Plus, track some pretty interesting individual stock stories. Names like Bajaj Finance popping up, Suzlon, Reliance Power, and even that whole cooling appliance sector with Havells, Voltas, Blue Star, Whirlpool.
So our mission today is pretty straightforward. Understand the main drivers behind the market's performance on that specific day and see if we can spot any potential clues for, what might be coming next.
Okay, let's unpack this then, starting with the headline news. The end of that 7-day rally, the Sensex dipped 0.39%, closing at 79,801.43.
Right, and the Nifty 50 was down a similar amount, 0.34%, finishing at 24,246.70.
And that winning streak, by the way, it wasn't small. It gave us gains of over 8%. So what actually put the brakes on?
Well, the primary reason being cited everywhere is profit booking. Makes sense, right? After such a big climb.
Sure, people want to lock in those gains.
Exactly. Especially when there weren't any major new positive developments, no fresh triggers to keep pushing things higher. It's just a natural reaction for some investors.
Like reaching a summit and taking a breather.
You could think of it like that, yeah. You pause, enjoy the view, maybe before deciding the next step. And, the continued uncertainty around potential U.S. tariff moves, particularly involving former President Trump, probably added to that feeling of maybe taking some risk off the table.
That makes sense. It's like, why wait and see if things get trickier? Interestingly, though, the mid-sized and small-cap companies seem to hold up a bit better.
They did. The BSE mid-cap was only down slightly, 0.16%, and the small-cap was almost flat.
So what does that tell us? Maybe less urgency to sell there?
Could be. It suggests that while some investors were definitely selling off their bigger holdings, maybe there was still some confidence, or perhaps less profit to book in those broader market segments.
Okay.
And it's also really important to note, even with the overall dip, we still saw a good number of stocks, 75 in total, hitting new 52-week highs.
Wow, 75, including some big names.
Yeah, Bajaj Finserv, Bajaj Finance, GlaxoSmithKline Pharma, SBI Cards, Ultratech Cement, UPL, quite a list. That contrasts with only 25 stocks hitting 52-week lows. Names like Retagio Industries, East Coast Steel.
So definitely not a uniformly negative picture then. There was divergence.
Absolutely. Now here's where things get a bit more complex. There was also the geopolitical situation.
Ah, yes, the attack in Kashmir. That definitely casts a shadow.
It does. Understandably created a sense of unease. And India's diplomatic response towards Pakistan, suspending the Indus Waters talks, Prime Minister Modi's firm statements, that introduces an element of caution for investors.
Geopolitical uncertainty almost always makes investors hesitate, doesn't it?
It really does. Potential instability, potential conflict. Investors tend to become more risk-averse. Those events certainly raise that possibility.
Okay, so that's the domestic picture. Now let's zoom out and look at those weak global cues that were mentioned as part of the reason for the profit booking.
Right. And one really eye-catching development was in Japan. Nippon Life Insurance Co., they're the biggest life insurer there, decided to reduce its holdings of Japanese government bonds, or yen bonds.
Reduce holdings? But weren't yields getting more attractive? You'd think they'd be buying.
That's the counterintuitive part.
Yeah.
But Nippon Life specifically cited concerns about market instability, low liquidity, and just heightened volatility as their main reasons, despite those appealing yields.
Interesting. So stability concerns trumped yield appeal for them.
Seems like it. And it's a significant move because, a company managing that much money can influence sentiment.
And it wasn't like all Japanese insurers were doing the same thing, was it?
No, not at all. We saw Meiji Yasuda Life Insurance also looking to reduce yen bonds, but actually increase their foreign asset investments. Meanwhile, others like Fukoku Mutual and Dado Life were actually increasing their domestic bond holdings.
Wow, quite a split in strategy. What does that tell us about the global outlook? It sounds uncertain.
It really underscores the significant uncertainty out there. And a key factor feeding into this, as we've talked about before, is the fallout from U.S. President Trump's tariff policies.
Right, the trade tensions.
Exactly. They've created considerable volatility and have even led some investors to question the traditional safe haven status of the U.S. dollar and U.S. treasuries. We'd actually seen record foreign money flowing into Japanese long-term bonds just the month before, seeking safety.
So Nippon Life's move feels like a reaction against that flow, worried about the volatility within that safe haven.
That seems to be the case. It reflects this broader unease about global stability. They even mentioned expecting the Bank of Japan to potentially raise rates to 0.75% and Japan's 10-year yield going up to maybe 1.4%.
But those expectations are clouded by the trade war uncertainty, right? Makes it harder for the BOJ to actually hike.
Precisely. It's all so interconnected. Trade disputes, policy shifts in one place. They create ripple effects everywhere, impacting interest rate decisions and market stability globally.
Okay, shifting gears a bit now, let's talk gold and silver. Gold prices had been on an incredible run, almost touching that 1 lakh per 10 grams mark recently. But on this day, Thursday the 24th, we saw some easing off those highs. What pulled gold back a bit?
Well, there are a few things at play. From a technical standpoint, the price charts were maybe starting to flash signs of trend exhaustion, suggesting the strong upward move might be losing steam.
Okay, technical signals. What else?
We also saw a slight rebound in the U.S. dollar index. Gold often moves inversely to the dollar, so a stronger dollar can make gold a bit less attractive for buyers using other currencies.
Right, the dollar effect.
And interestingly, those comments from President Trump about potentially easing tariffs with India and Japan might have also played a role. Less tension could mean less demand for gold as a classic safe haven asset.
So a mix of technicals, currency moves, and maybe a slight easing of trade fears.
Got it. Looking at the specific numbers around mid-morning on the 24th, MCX gold was actually up a little while silver was down slightly. Yeah, prices fluctuate through the day. And the Indian Bullion Association's rates often differ slightly too, depending on purity, 24 karat versus 22 karat, and so on.
It's a good reminder about checking different sources and time points.
Absolutely. And city-specific prices show local variations too, although the bullion rates and MCX rates within a city are usually quite close. But the main takeaway was that overall trend prices easing off those recent record highs was pretty clear across Mumbai, Bengaluru, Chennai, Delhi, Hyderabad, Kolkata.
Okay. Now let's dive into some of those individual company earnings reports and how they moved the stocks. First up, Hindustan Unilever, HUL. They reported a 3.7% year-on-year fall in net profit for Q4 FY25.
Right, a 2,464 crore. On the surface, a dip in profit doesn't sound great.
No, it doesn't.
But you have to look a bit deeper. Their total income actually increased by 3.5%. And you break it down by segment, home care, beauty and well-being, personal care, they all saw revenue growth.
So where was the drag?
It was mainly the food segment that saw a small dip. And importantly, they proposed a final dividend of 24 times per share. That's often seen as a positive signal, sharing profits with shareholders.
Okay, so revenue up in most areas, dividend proposed. What was the management saying about the future?
CEO Rohit Jawa sounded cautiously optimistic. He mentioned anticipating a gradual improvement in demand conditions over the coming fiscal year. He also talked about their ongoing strategic efforts to reshape their product portfolio and strengthen their market position.
But the market didn't seem too impressed immediately, did it? HUL's share price dropped quite a bit that day.
It did, yeah, down about 4.13%. An analyst, Rajesh Posel, pointed out technical resistance around 2,450 and immediate support near 2,300. So it seems the market, at least in the short term, really focused on that profit decline more than the revenue growth or the future outlook.
Shows how different metrics can sway sentiment day to day.
Definitely. Next up, ACC, the cement maker. They also reported a fall in consolidated net profit, a pretty significant one, over 20% year on year.
Another profit dip. But what about revenue?
Revenue was actually up strongly by 12.7%, so it does seem a bit puzzling at first glance.
Yeah, higher revenue, lower profit. Suggests maybe costs went up.
That's a likely factor. However, they did report their highest ever quarterly sales volume, which is a very strong indicator of demand for their cement.
Okay, record volumes, that's positive.
And their CEO, Vinod Bahety, sounded positive too, talking about their capacity expansion plans aligning well with the country's growing infrastructure needs. Plus, they proposed a dividend of 7.50 per share.
So underlying positives despite the profit number. What about the technical view on ACC?
Interesting one here. Analyst Anshul Jain highlighted a potential bullish pattern forming on the charts, something called a cup and handle.
Ah, classic pattern. Suggests potential upside.
Often, yes. It suggests a period of consolidation, potentially followed by an upward breakout. Gene suggested that if the stock managed to break above the 2,100 level, it could potentially rally towards 2,250. So, despite the reported profit dip, some technical optimism there.
Okay, moving on to Maruti Suzuki, India's biggest car maker. Their results weren't out yet. They were due the next day, April 25th. But the stock price actually gained on the 24th.
Right, which suggests some positive anticipation from the market.
So what were the expectations for their Q4 results?
Generally, analysts were forecasting a slight dip in net profit compared to the previous year. But they expected revenue to grow, driven by both higher sales volumes and some price increases.
But lower profitability anticipated. Why?
Mostly due to increased costs. Things like depreciation from their new Kharkhoda manufacturing facility kicking in, plus higher spending on marketing and discounts to maybe push sales. So kind of a mixed bag of expectations.
Yet despite that expected profit pressure, major brokerages like Motilal Oswal and HDFC Securities had buy ratings out with pretty decent target prices.
They did. And technically, Anshul Jain, again, saw potential for a rally if the stock could break above the 12,100 mark. It seems the market might have been looking beyond just the immediate quarterly numbers.
Focusing more on the longer-term story for Maruti.
Possibly. Future growth potential, market leadership. Those factors can sometimes outweigh short-term earnings bumps. And Maruti has delivered strong long-term returns historically, even though its stock had been a bit flat in the 3 months leading up to this.
Okay, now Nestle India. They did report their Q4 numbers. And guess what? Another profit dip down 5% year-on-year to 885.4 crore.
Seems to be a theme, doesn't it? Though, like ACC, their revenue was actually up by 4.5%. They also announced a dividend, 10 years per share.
What was driving Nestle's revenue growth?
They actually reported their highest ever domestic sales, driven mostly by strong volume growth in their beverages and confectionery segments. So clearly, people are still buying their products.
Good demand, then. Any other highlights?
They mentioned a pretty hefty capex plan year of 6,500 crore, suggesting significant investment in future growth.
Okay, investment for the future. How did the stock react on the day?
It was a bit volatile. It actually traded higher initially after the results came out, but then it dipped and closed lower. So maybe a slightly muted reaction overall. Perhaps the market was hoping for stronger profit growth despite the revenue beat.
Right. And technical analysts would have been watching those support and resistance levels closely after the earnings, just like with HUL.
Exactly. Now let's switch to a stock that had a really positive day, bucking the overall market trend, Bajaj Finance.
Ah, yes. A big rally, up 4% intraday, and it hit a market cap of $6 trillion. What was driving that excitement?
The main catalyst was an upcoming board meeting. The company announced they were going to consider several potentially shareholder-friendly actions.
Like what?
A special interim dividend, possibly a stock split, and even potentially a bonus issue of shares.
Okay, dividend, split, bonus. Those are things the market usually likes to hear.
Absolutely. They can enhance shareholder value, increase liquidity in the stock, and Bajaj Finance has done bonus issues and stock splits before, so it's something investors familiar with the company might anticipate positively.
And their recent business update was pretty good too, wasn't it?
Yes, their Q4 update had already shown healthy growth in assets under management, good customer additions, strong numbers on new loans booked. So this news about potential corporate actions likely just added fuel to the fire, boosting confidence further. Brokerages, though, are still keeping a close eye on their margins and asset quality.
Makes sense. Okay, another stock that did well despite the weak market was Suzlon Energy. Share price jumped. What was the good news there?
Suzlon's strength seems linked to recent order wins. They're in the renewable energy space, specifically wind power.
Right.
They announced securing new contracts from NTPC Green Energy and also Sunsure Energy. These wins signal continued business momentum and align well with India's big push towards renewables. That likely reassured investors about their growth prospects.
Good news flow helping them. What about Reliance Power? They also saw a big jump, about 7%, with high trading volumes. Any specific news there?
Not really any major company-specific news announcement that day, like earnings or big contract. Ruchit Jain from Motilal Oswal offered a technical take.
What was his view?
He noted the stock had been trading sideways, kind of stuck between resistance around 48.49 and support down to 41. His advice was basically for existing shareholders to hold on, but he didn't see it as a trigger for fresh buying. Suggests the move might have been more technical or maybe speculative.
Okay, so maybe not fundamentally driven that day, but it's a stock that's done well long-term, right?
Yes, it has delivered very strong returns over a longer period.
Let's shift to a whole sector that was definitely seeing positive action. Cement. Cement shares rallied quite noticeably, some up 5%.
That's right. The main catalyst seemed to be Dalmia Bharat's Q4 operational performance update.
What did they report?
They announced better than expected volume growth and also improved operational efficiencies. That seemed to lift sentiment not just for Dalmia, but across the whole sector. We even saw giants like Ultratech Cement and also JK Cement hitting new record highs that day.
Wow. And looking at Dalmia Bharat's numbers specifically.
Well, their year-on-year revenue was actually slightly lower, but they showed really strong growth compared to the previous quarter, both in sales volume and profitability.
And the outlook for cement generally is looking pretty good.
Seems to be. The expectation is for robust demand, fueled by continued economic growth and all the government spending on infrastructure. Plus, there's talk of potential price hikes coming soon.
Right, before the monsoon season, often.
Exactly. That could help them offset any rise in input costs, like pet coke. But of course, the key things analysts are watching are, does that demand actually materialize strongly? Can they sustain those price increases? And where are input costs headed?
Okay. Now, on the flip side, let's look at consumer durables. Stocks like Havells, Voltas, Blue Star, Whirlpool, they were facing a negative bias. Even with the IMD warning about heat waves, why weren't they rallying?
It seems the market was reacting more to reports suggesting a possibly delayed start to the summer demand season, especially in southern India.
So the heat wave warnings were there, but maybe sales weren't picking up as fast as expected.
That could be it. Plus, you still have the backdrop of relatively high inflation, possibly pinching consumer spending on discretionary items like air conditioners or refrigerators.
Makes sense. And the technical picture for those stocks was quite varied, wasn't it?
Yes, very mixed. Cautiously positive for Voltas, positive for Havells, actually negative for Blue Star, and neutral for Whirlpool, according to one analyst's view. Each had specific support and resistance levels traders were likely watching. So definitely not a uniform picture within that sector.
We also saw Tata Consumer Products report their Q4 earnings. How did they do?
Quite well on the profit front. A strong 52% year-on-year surge in net profit.
Wow. But how did the stock react?
It also experienced some volatility during the day. Again, technical analysts were likely focused on key support and resistance levels to figure out the next moves after the results.
And looking at the broader FMCG sector index, the Nifty FMCG,
it was approaching a potentially significant resistance zone, its 200-day moving average, and also a weekly trendline resistance.
So a key technical level, could it break through?
Well, some technical indicators were actually suggesting a potential positive breakout might be on the cards. So even though some individual FMCG stocks like HUL saw pressure, the overall sector picture technically looked a bit more hopeful, perhaps.
Interesting contrast. Now, we mentioned geopolitical factors earlier regarding Kashmir. Did that have any impact beyond India?
It certainly seemed to. We saw reports of a sharp drop in the Pakistan stock market, the Karachi 100 index, following India's diplomatic measures after the attack. It really highlights how quickly geopolitical events can spill over and impact investor sentiment in neighboring markets.
A clear regional impact, then? Any other major business news nuggets from the day?
Yes, a pretty significant contract announcement. Amial Mega Engineering and Infrastructures Limited secured a huge contract worth of 12,800 crore from NPCIL, the Nuclear Power Corporation of India.
What's the contract for?
For the construction of two 700 millimeter Prafikwe pressurized heavy water reactors. It's a big deal because it marks MEAL's entry into the nuclear energy construction sector.
Wow, that's a major step for them and significant for India's nuclear program, too.
Absolutely. A big diversification for MEAL and supports India's nuclear power goals.
And finally, just to round things off, how did the Indian rupee fare against the US dollar that day?
It actually closed higher, strengthening slightly to 85.27 against the dollar.
Which can sometimes be seen as a positive sign for the domestic economy, right?
Often interpreted that way, yes. Bit of resilience there, despite the equity market dip.
Okay, so to try and wrap all this up, our deep dive into Thursday, April 24th shows, well, a market taking a deserved breather after a strong run.
Yeah, influenced by a mix of things. Straightforward profit booking, those geopolitical concerns we discussed, and maybe some cautious signals from the global stage.
And company earnings were a real mixed bag. Some showed those profit dips despite revenue growth, like HUL and ACC, while others, like maybe Tata Consumer, had strong profit surges. Bajaj Finance stood out with its rally on corporate action news.
Exactly. And those earnings, along with company outlooks and specific news like order wins for Suzlon or potential actions for Bajaj Finance, clearly drove individual stock movements, sometimes against the overall market trend. It was definitely a day where looking beneath the surface of the main indices was crucial.
It really feels like the market was sending some mixed signals. You had resilience in some pockets, like maybe pharma or select cement stocks, as you mentioned.
Right.
While others, particularly parts of FMCG and those consumer durables, faced some definite headwinds. It really just underscores how important it is for you, the listener, to do that deeper individual stock analysis.
And to stay aware of all these interacting factors. Global events, domestic policy, company performance, sector trends, it all feeds into market sentiment.
Which leads us to a final thought for you to chew on. Given this complex interplay we've discussed, earnings, global uncertainties, technical signals, geopolitics, what do these market movements on a day like April 24th suggest about the overall resilience and maybe the future direction of Indian equities in the coming weeks and months?
That's the big question, isn't it? Definitely something worth reflecting on as you navigate your own investment decisions. And please, always remember, the information provided during this deep dive is strictly for educational purposes only. It is not financial advice.
That's right. We are not SEBI-registered advisors.
Investing in stocks carries inherent risks, including the potential loss of your capital. It's really important to consult with a qualified, SEBI-registered financial advisor before making any investment decisions. We cannot be held liable for any losses that might result from decisions made based on the information shared here.
And for unbiased updates, do make sure you subscribe to the Bull Bear Buzz podcast.